4, evaluation of customers. 13 questions on the test coming from evaluation of customers. Now, folks, let me just say this. This section right here is talking about suitability. We're going to give you some charts here in this section that's going to help you with suitability questions. You memorize these charts and you can answer virtually any suitability question you're asked, and you are going to be asked a lot of suitability questions. Now, investment risk. The first investment risk is credit risk. This is also known as financial or default risk. This risk deals with bonds. This risk deals with bonds. This is the risk that the issuer of a bond will default on the bond issue. They won't pay the interest, they won't repay the principal. The next investment risk is business risk. This is also known as capital risk. This is the risk that if you invest in a company that something happens to that company's business. You know, maybe the product the company offers falls out of favor, or maybe the management does a poor job managing the company, takes on too much debt. Next risk when we invest is market risk. Market risk. There's beta on stock and there's interest rate on bonds. Now, what is that interest rate risk? This is the risk that if interest rates go up, bond prices will go down. Now, what about beta on stock? Beta. Beta is a measure of volatility. Beta is a measure of volatility. Let's say that we have a stock or a mutual fund that has a beta of 1. This stock or fund would be as volatile as the general market. So if the general market were to go up by 10%, we would expect this stock or fund to go up by the same 10%. But if the market were to go down by 5%, we would expect to see this stock or fund go down by 5%. So a stock or fund that has a beta of 1 is as volatile as the general market. Now, what if we have a stock or fund that has a beta of more than 1? More than 1. Now this stock or fund would be more volatile than the general market. More volatile than the general market. So the market were to go up by 10%, we would expect to see this stock or fund go up by more than 10%. If the market were to go down by 5%, we would expect to see this stock or fund go down by more than 5%. What about a stock or fund that has a beta of less than 1? Less than 1. This stock or fund would be less volatile than the general market, less volatile. If the general market were to go up by 10%, this stock or fund would go up by less than 10%. If the general market were to go down by 5%, this stock or fund would go down by less than 5%, less volatile than the general market. The next risk is reinvestment risk. This is the risk that when you get money back from your investments, you're now going to have to go out, reinvest that money in a marketplace where returns may be lower. Let's say that I have bought a bond that pays me 8% interest. So I'm receiving $80 a year in income. $80 a year in income. This bond matures. I get my principal back. I'm now going to take this money, reinvest it into another bond. But now interest rates are no longer 8%. Now interest rates are 3%. That's reinvestment risk. Risk that when you receive money back for your investments, you would reinvest those funds at a lower rate of return. Now, what's call risk? Call risk is the risk that if you have a callable bond or callable preferred, as interest rates fall, your bond or preferred stock would be called in. You'd get your money back sooner than anticipated. Of course, now you got to take that money, go out, reinvest that money in a marketplace where returns are lower. Returns are lower. Well, Dave, how do we know returns are lower? Well, when would an issuer call in a bond, or when would an issuer call in preferred stock? When interest rates fall. When interest rates fall. So we would be taking our money, getting our money back from the issuer. We would take that money out into the marketplace, reinvest it, and get a lower rate of return. So call risk and reinvestment risk kind of go hand in hand. The next risk we have here is purchasing power risk. This is the risk of inflation. What type of securities have the risk of inflation? Any security that pays a fixed income, fixed rate of return, runs purchasing power or inflation risk. What did we look at? What did we look at in chapter number 1 that would have inflation risk? Bonds, preferred stock, okay? Also, inflation risk would be something we would assume with a fixed annuity, And we're going to talk about the fixed annuity a bit later. Interest rate risk. This is the risk that if interest rates go up, the price of bonds go down. Interest rate risk and market risk are really the same thing as it relates to bond prices. Liquidity risk. This is marketability risk. Now, what is liquidity risk? What is marketability risk? This is the risk that if I get ready to sell a security that I own, there's nobody out there who wants to buy that which I'm selling. Now, is there anything that has no liquidity risk, no marketability risk? There is. In your studies, hopefully you saw this. It's a mutual fund. Mutual funds are guaranteed to be redeemed by the mutual fund company. So there is no liquidity risk with a mutual fund. Next is legislative risk. This is risk that if Congress were to change tax laws relative to investments, that this would have a negative impact on the value of our investments. Yeah, so if the tax rate on capital gains were to be increased, that would probably have a negative impact on the value of investments. If the tax on dividends were to be increased, that would probably have a negative impact on the value of investments. That's legislative risk. Currency risk. Currency risk has to do with investing in foreign securities, where you have to exchange U.S. dollars into a foreign currency. Systematic versus non-systematic risk. Systematic is a tendency of prices moving together. Non-systematic involves underlying investments. So systematic risk would be market risk. You know, I buy stock in a company. Company's doing great, but the stock price of the company I buy falls in value because the market in general is falling in value. That would be a systematic risk. Non-systematic risk, that would be business risk. This has nothing to do with the market. This has to do with the underlying investment. The company is being run poorly. Now let's talk about suitability of investments. There's a table right here that talks about the type of fund, the portfolio, and what this would be suitable for. What investment objective this would be suitable for. Now we have quite a few different fund types on this table. I'm not going to read through this for you. You can read through this your own. But I want you to memorize this information right here because this is going to help you answer questions on suitability. And I mentioned earlier, you're going to see quite a few questions on suitability. These questions are going to be scenario based. They're going to give you a scenario. You have a customer who is 35 years of age. They're looking for growth of invested capital. What would you recommend? So this is going to help you answer those questions. This table, same thing. We're not going to read through it, but learn it. It's going to help you answer questions. There is something I want to point out here on this table. I'm not going to read the whole thing, but I want to point out the third item down. Corporate bond funds, investment grade corporations, investment grade corporate bond funds. There are two bond rating companies, primarily two. There's three, but for our purposes, we're going to say there's two. There's Standard & Poor's and there's Moody's. If we're looking at a Standard & Poor's rating, any rating of BBB or better would be investment grade, suitable for a conservative investor. If it is a Moody's rating, that would be Baa or better. Now, the difference between Standard & Poor's and Moody's, Standard & Poor's uses all uppercase, Moody's uses upper and lowercase. So if it's a Moody's, Baa or better would be an investment grade bond, suitable for conservative investors. Now, if it is a bond rating lower than BBB, Standard & Poor's, or Baa Moody's, now we're looking at what's known as a junk bond. These are high-yielding bonds. These are suitable for investors who are very speculative, high risk, suitable for speculative investors. Once again, we've got a table. I'd like for you to just memorize this table. Information here is going to help you answer questions on suitability, type of fund, portfolio, and who is this suitable for. Here's another test tip for us. Use whiteboard and marker. When you check into the test center, ask the folks behind the counter to give you a whiteboard and marker. And then I want you to use that whiteboard and marker as you work through the exam. Don't try and do things in your head. If there's some type of math question you need to do, use the whiteboard marker. Put the information down on a whiteboard marker. You have probably created a personalized study sheet for yourself. I would take some time after the clock has started on the exam to take that information from your personalized study sheet and copy that on the whiteboard, and then use that to help you as you work through the exam, to kind of lighten the load on your brain as you move through the exam. Hopefully this test tip is valuable and will help you work through the exam.